So today we are going to look at what we did last week. As you know, last week we looked at sole proprietorship. So in sole proprietorship, we looked at how a trading business could be monitored and how that operation runs about. So in that, I'll just quickly run through. We had an introduction, then I explained how the sole proprietorship works, and then I also discussed about the advantages and disadvantages, and then we had a look at the profitability, or in other words, how the profitability will be measured in the sole proprietorship business at two levels, where namely the gross profit and the net profit. So, and also there are two levels of preparing the P&L also, where we call it as trading account and then the profit and loss account. So trading account is basically to find out the gross profit of the business, and the profit and loss account will give you the net profit of the business. So gross profit, basically we said that it is sales minus cost of sales. That is, when you sell a product, so that is called as your sales. Sales will be number of quantity into the selling price. But the sales can happen in two ways, as you already know. It could be a cash sale or a credit sale. Okay. So whatever it is, we consider both as to be sales, because in the credit sales, you know, the cash will be collected later. But when you are preparing financial statement, that is not relevant. Okay. So we need to prepare financial statements on accrual basis. So as a result, what we consider is whether it is collected or not, we will consider the credit sales also as part of sales. Then we also have the cost related to that sale, all the direct cost that is related to the sale. So this includes your purchases, carriage inwards, purchases returns, all those will be included under that. And here you know that you have a opening stock and then you end up with a closing stock. So the difference between the two will give you the number of units that you have sold and also the relevant cost relating to those units. So this is the trading account structure. So in the cost of sales, there may be certain items here and there depending on the question, but this is more or less the standard format. And then we also went on to look at how you prepare the profit or loss account. So that include, starting with the gross profit, we have the other income, and then we have the other expenses, and you reach the net profit or loss. So expenses can be categorized into three categories: administrative, selling and distribution, and financing. And I also gave some examples relating to those expense items. And finally, this is the structure of the balance sheet, where we start with the assets and you have a total there. Then you start with the capital, and capital, you know, you have a capital balance, and then you add the net profit or loss, because the profitability is purely belonging to the sole proprietor. So there is no problem here, because everything that is relevant to the business goes into the sole proprietor. But according to the entity concept, we have to look at these two as two separate entities. So whatever that is taken by the sole proprietorship for personal use, that we call it as drawings, and drawings have to be deducted. And the sole proprietorship might have borrowed long term, maybe that is more than 12 months. And you will also have short term, which is falling within 12 months. So we will learn these definitions when we go on to LKAS 1. And then you have current liabilities, and finally the provision for bad debts. Then I also had two questions given. So I would like to discuss the past paper question, which is March 2017 right now. So before that, if you have any questions, you may raise now. Okay. So let's look at the question now. The question says, Nelum Bank PLC is currently assessing a loan application. So as I told you, why this business of sole proprietorship is important to us is you might get these type of businesses as one of your customers, because customers requesting for loans will produce these type of financial statements. So you need to know how to evaluate the financial statement, because if you don't know how to prepare a gross profit and net profit calculation, then how are you going to assess this loan application of the customer? So that is why we are learning that sole proprietorship is important, because you might get customers falling into that category. Okay, right. So Nelum Bank PLC is currently assessing a loan application submitted by its customer, Lotus Traders. So this person's name of the business is Lotus Traders, for a new loan of rupees 100,000. Answer the questions based on following ledger accounts of Lotus Traders for the year ended as at 31/12/2016. So they have given a set of ledger accounts. Now, what do you understand by this ledger accounts? Now, if you know that when we prepare the trial balance, we extract a list of balances of all your accounts. So which means in your ledger, if you have 1,000 accounts, those 1,000 accounts should appear in the list of accounts, and which is put into debits and credits. And the debit total should agree with the credit total. But whereas in this case, it is only an extract. They are not talking about the entire list of accounts of Lotus Traders. They are just giving you bits and pieces of Lotus Traders. So likewise, they have sales, cost of sales, other income, operating and other expenses. Likewise, they have given some items. So based on those items, they want you to answer the questions below. Let's look at the questions now. Calculate net profit of Lotus Traders for the year ended 31/12/2016. So they want you to calculate the net profit. Then calculate two financial ratios that are useful for assessing the repayment capacity of Lotus Traders. So which we haven't done yet. We will look at it when we go on and learn financial ratios. So I'm not going to do that now. Third part, what is the applicable accounting concept for accounting of payable water bills? So that you know, because we have already learned the concepts. Then the last part, in terms of accounting, what is the main difference between current and long liability, which is again, we are yet to learn, that is LKAS 1. So once we do that, we will come and answer this question. So parts 2 and 4, we are not going to deal with now. We will look at part 1 and 3. So among that also, let me look at part 3 first. What does part 3 say? What is the applicable accounting concept for accounting of payable water bills? Payable water bills. So let me go back to the list. And if you see the list of balances, there is one item called payable water bills. So they have 10,000 there. Now this payable water bills is what? Simply what we need to understand is, as I told you when we were doing the trial balance questions, From the list of account balances, you need to identify each item to which class of account it belongs to. That is sales, cost of sales, other income, operating and other expenses. So likewise, you need to understand to which class of account this belongs to. Can we take 1 minute and do it quickly? Yes, first item, sales. Sales is an income. Cost of sales, an expense. Other income is an income. Operating and other expenses, an expense. Fixed assets, that is an asset. Payable water bills. Now here comes the question. This is what part 3 is. So payable water bills is what? That is a liability. A liability. Now payable means it's a liability where you have an obligation to pay. So here in this Lotus Traders, they say they might have had a bill which is amounting to 10,000 rupees or maybe a accumulated amount of 10,000 rupees. As at 31st 12/2016, they might have to pay this. So by December, they haven't paid it. It's a liability. It's a liability. Then you have current assets, current liabilities. Those current asset is asset, current liability is liability. Then you also have long-term liabilities. Long-term liabilities. It is again a liability. Then finally capital. Capital is your equity. Okay. So that understanding is not very important to this question, but there is another part which you might need to know that also. But looking at this, now we know payable water bills is a liability. Now let us go back and answer the third part first. What is applicable accounting concept for accounting of payable water bills? So how will the payable water bills come into the financial statements, or because of doing what it comes into the financial statements? Can somebody tell me? So can anyone answer why or how they have gotten this payables thing into their books? Can anybody answer that question? Why they have got this water bills payable into their books? So simply because they have looked at the bills that were not paid by the business as at December 31st, as at this December 31st, yeah. And as a result, they need to account for that particular bill. So because of that, only it has come. So what it means is they have accounted for the water bill, water expenses, water consumption expenses on accrual principle. We have told no that whether you have irrespective of whether you have paid or not, you have to account for them based on whether you have incurred it or not. So here water would have been consumed and they might have not paid the bills, but for accounting purposes you need to account for it on the basis of accrual concept. So it is very interesting to note that if you look at this question, what is the applicable accounting concept for accounting of payable water bills as shown in the above financials? Now when you say go and answer this as accrual concept, you get 5 marks. because each question will carry 20 marks and each part will have 5 marks. So for answering this accrual concept, you will get 5 marks. So if somebody doesn't know this, means you are just going to lose 5 marks. That's why I repeatedly tell you all the importance of revising and being up to date with all what we learn. Because even a topic like accounting concepts is very important, because it might appear like a question like this. So answering accrual concept, you get 5 marks. Okay. Then the next one will be calculating the net profit or loss of Lotus traders. So in order to do that, let us identify the items. So you have already marked the income and expense items. So your income is sales, your expense is cost of sales, then you have other income, then operating and other expenses, and that's it. So you have only 4 items, 250, 200, 10 and 50. So looking at those numbers, let's look at it in the board. So Lotus traders profit or loss account for the year ended 16. Okay. Then you have to say what is the currency that we are using, so it will be in rupees. And first item, sales. So sales 250,000. Then less cost of sales, that is 200,000. So when you deduct one from the other, you get 50,000. That is called your gross profit. Your gross profit. So to your gross profit, you will add your other income. I think which was 10,000. Then deduct other expenses. That will be a negative 50,000. So ultimately, you have 10,000 to be your net profit. So look at this question, very straightforward, very simple question. Only thing, you have to remember the items and the format for the financial statement. If you know that, you can easily get the 5 marks. Okay? So you can take down this. This is what is required in exams. This is what you have to write also. Only 4 5-line items. So if you know that clearly, you can answer this question. Okay, fine. So that is all about sole proprietorship. So now let's move on to the new topic. which is the new topic on property, plant, and equipment. So property, plant, and equipment is the new topic that we are going to learn. And by the way, this is an accounting standard. This is an accounting standard. So you have to be very careful whenever you learn a new accounting standard, because sometimes you might have to be, you might have to write the name of the accounting standard. So it is very important that you know how to write the accounting standard. So in this case, this particular standard is named as LKAS 16. Okay. LKAS 16. Right. And when you are asked to write you will have to say Sri Lanka accounting standard you can write it continuously. I am just writing it on the board depending on the visibility to you all. So this is how you write it. Sri Lanka accounting standard LKAS 16, and the name of the standard is property, plant, and equipment. So likewise, every accounting standard that we learn, you need to be in a position to write the name of the standard. Sometimes the question will be directly asked, what is the relevant accounting standard? So when they ask what is the relevant accounting standard, you can't just go and say LKAS 16, or you can't say property, plant, and equipment. That's incorrect. You have to write it complete. Sri Lanka accounting standard LKAS 16 : property, plant, and equipment. So this is actually the name of the accounting standard. Name of the accounting standard. This is how you have to write it. So please take down how you write the accounting standard. Okay, right. So now let's go into the topic: property, plant, and equipment. So the objective of the standard is where it tries to explain the accounting treatment, that is how you account for certain items in your financial statements, for property, plant, and equipment that you have purchased. So in your business, day-to-day operations, you might purchase various types of fixed assets. Property, plant, and equipment means, in other words, it's the fixed asset. So when you purchase fixed assets, first we need to know how to account for them, and we need to identify whether it belongs to the category of fixed assets. That is also a question. So it is very important that this standard tries to explain the accounting treatment for property, plant and equipment. And the main features of accounting for PPE includes the recognition of assets. Now you pay for something and you buy an asset. Now in your balance sheet, you will know, even in the questions that I have given, you will see there are a number of assets displayed on the asset side, asset items. Now out of these, what is going into fixed assets or property, plant and equipment? That is called as recognition. How do we consider this as an asset or a fixed asset? Then second, determination of its carrying amount. So I'm not going to talk about carrying amount at this point in time because we have that as we go on. So we need to identify what is going to be the carrying amount of this item. Then the depreciation, very important term that we are going to look at. The depreciation, that is the wear and tear due to the usage of the asset. The wear and tear due to the usage of the asset. Then we have another term which is called impairment losses to be recognized in relation to them. So impairment losses, when we learn that, I will come to that in detail. Right now you understand that there is a loss or there could be a loss to the asset that you are using. So when that happens, how do we account for that? The scope of the standard. So first, every standard might have an objective and it will also have a scope defined within the accounting standard. So here comes LKAS 16 should be followed when accounting for PPE unless another Sri Lanka accounting standard requires a different treatment. So this is very important. This statement is very important. Now, as I told you, there are various types of fixed assets. Now, if there is a fixed asset for which there is a separate accounting standard, then you should not use LKAS 16 for that purpose. Let's say something like this. You have tables, you have chairs. Now tables and chairs, you know that both are fixed assets. Okay? Tables and chairs, both are fixed assets. Now the accounting standards body say that if you have chairs in your business, you have to use LKAS, let's say I'm just taking a number, LKAS 21. Of course, LKAS 21 is something different. We will look at it later. I'm just saying that if you have chairs being used in your business, that will be covered by LKAS 21. So which means your tables will be covered by LKAS 16. That is what it means. You should not be using LKAS 16 for the chairs that you are using. Okay. So what does it mean? LKAS 16 should be followed when accounting for PPE unless another Sri Lanka accounting standard requires a different treatment. And they clearly say LKAS 16 does not apply to the following. So there will be few items, we will look at it. And they say LKAS 16 cannot be applied for these items. Number one, biological assets related to agricultural activity. Biological assets related to agricultural activity. Now, you know there are various types of businesses. Say, for example, we looked at a trading business. And in a trading business, they will also have tables, chairs, likewise, they have. Now, since we are in a bank, we know that even we are using various types of fixed assets. So there also we make use of various types of fixed assets. Okay. Now, what about a tea plantation? If you look at a tea plantation, what is the fixed asset for the tea plantation? Again, it will be the same tables, chairs, and so on. But in addition to that, they also have, what do these tea plantation companies have? They have tea estates. These tea estates consist of so much of tea plants. Tea plants, those are called biological assets. Those are called biological assets. Now, since because it is an asset, you don't consider it to be a fixed asset. Because if it is a fixed asset, you will go and apply LKAS 16, but that is wrong. For biological assets, you can't apply LKAS 16 because it is governed by another standard, which we will not be learning because that is not relevant for this particular course module. Then in some countries, even we also have mineral rights and mineral reserves. You know there are mineral reserves. So those are again not considered as fixed assets. So these mineral reserves will include oil reservoirs, gas, and any other non-regenerative resource. So anything that is falling in the kind of non-regenerative resource means those are also not considered to be fixed assets. Okay, those are also not considered to be fixed assets. And thirdly, PPE classified as held for sale. What does this mean? I can give you an example. Let's consider the Damro furnitures. Okay. Now Damro has, what is their business? Selling furnitures, and they also into other areas also, but basically they do the furniture business. Now these furnitures, they have it in their showrooms for the purpose of selling, for the purpose of selling. So that is what we call as classified as held for sale. Please underline, if you are having a note in your hand, please underline the term held for sale. Held for sale is very important because Damro, Singer, and so many other companies where they sell furniture items or maybe equipment, those are, they are holding it for sale for people to come and buy. Now, those items in general, when we look at it, it's like a fixed asset. They sell tables, chairs, beds, TVs, so many things, refrigerators. All these are fixed asset in a normal business. But when we look at these type of businesses where Damro, Singer, and others concerned, they are keeping those items in their showrooms for the purpose of selling. Now, if those are kept for selling purposes, then you can't call them as property, plant, and equipment. That is, it is not a fixed asset. So if it is not a fixed asset, then you can't apply LKAS 16. Is it clear? Because this differentiation has to be understood properly. Where LKAS 16 is not going to apply. For biological assets, for mineral reserves, and especially any asset that is held for sale. Held for sale. Now let's get into the definitions. So the first definition is, what is property, plant, and equipment? What is property, plant, and equipment? So they say property, plant, and equipment is any tangible asset that is held for the use in the production or supply of goods or services, or for rental or for other or for administrative purpose. So it's very clear. Property, plant and equipment has to be tangible. Tangible means where you can touch and feel. Now this computer, I can touch it and see it is a computer. It's a keyboard. It's a mouse. So all these items are accessories to the computer. So we know that you can touch and feel. And why these are being used? Yes, it is being used for the purpose of production or supply of goods or services. So in order to provide a service, in order to produce a good, if you are using those type of assets, then they are known as property, plant and equipment. Okay. So how can we call something as some asset as a property, plant and equipment is it has to be a tangible asset, number one. Then it has to be used in the purpose of producing or supplying goods or services. And thirdly, or secondly, you know to know, are expected to be used during more than one period. This again a very important statement. Now say for example, you are buying a water bottle. Now this water bottle is something like a consumption. You buy it for the purpose of drinking it. Now this water bottle, can it be called an asset? Yes, it can be called an asset because water. So the problem here is, now by having this water bottle, are you going to produce or supply any goods or services? No. Then secondly, are we expecting it to be used during more than one period? Now the statement here used during more than one period means generally where we consider it to be used more than one financial year. Okay. So if you are buying any asset and if you want to call it as a fixed asset in your business, then you have to be mindful about that. Your asset has to be a fixed asset only if it can be used for more than one financial year. That is a very important statement. The asset has to be used more than one financial year. Okay, so please make a note here. That is under this expected to be used during more than one period. You can write it. Assets that are purchased to the business. Assets that are purchased to the business. And which are classified as fixed assets should be used for more than one financial year. Should be used for more than one financial year. More than one financial year. Okay. So if you are buying any asset and if you are considering that to be a fixed asset, you have to be mindful that you are intending to use this asset for more than one financial year. It has to be used for more than one financial year. Then the second definition is about cost and the fair value. Cost and the fair value. So we have two terms here. One is cost, one is fair value. Cost is the amount of cash or cash equivalent paid or the fair value of the other consideration given to acquire an asset at the time of its acquisition or construction. So the definitions you will have to remember, but it will be little too much because these are theoretical definitions. So you need to know to write in case if you are required to define these in exams. Okay. So what is cost is? Cost is the amount of cash or cash equivalent that you have paid. Now, if you are going to buy a computer where you will pay, let's say 100,000. So that 100,000 is the amount that you pay to buy this computer. And that is known as the cost of the computer or the cost of the fixed asset. So you are trying to acquire this particular asset. You are going to the shop, buying this computer, that is your acquisition. Now there can be a situation where you might also construct. Look at a building. Look at a building. So the building could be either acquired or constructed. Now if you are buying a building, let's say somebody buying a building on this particular area, they say 10 million. That is 100 lakhs. So when you say 10 million, that is the cost of the building. That is the cost of the building. Now, alternatively, let's look at an example where you have a land here and you start constructing a building there. So day by day, you will pay for labor, you will pay for material, for various things. All these you have to keep on accumulating. And once you have accumulated all the amounts, that is considered to be your cost. That is considered to be your cost. So the term here, cost, is relevant where you might acquire an asset, that is you go and pay and buy an asset directly. Or secondly, you can construct. In the case of a building, that is how it happens. So step by step, you start constructing your asset. So anything that you pay in relation to the construction of the asset is going to be your cost. And what is fair value? Fair value is the amount for which an asset could be exchanged between knowledgeable, willing parties in an arm's length transaction. So this is the theoretical definition of fair value. This term fair value, we will use it across various topics. There will be future topics that are coming up. So everywhere we will be using this fair value concept. Fair value is, in other words, also known as the market value. The market value. So what is market value is? Market value is the amount for which an asset could be exchanged between knowledgeable, willing parties in an arm's length transaction. When you say it is an arm's length transaction, means there is no biasness between the two parties involved in the transaction. And again, we also say knowledgeable, willing parties, which means both the parties, buyer and the seller, has to have a willingness to buy and sell, and they have to be knowledgeable about the market. Say, for example, let's say there is a building on this particular road where IBSL is located, and this building is worth about, let's say, 80 million, 80. So you want to buy this building and the seller is selling that it is 80 million. But for you, you need to have an idea what are the prices in this particular range, in this particular area. For a building of this kind, what is the price? When you do that finding, you become knowledgeable. You become knowledgeable in that particular area. Or yes, this area building values are somewhere close to 70 to 90 million, let's say. Now there is a willingness which has got created in you because this building is 80 million, which seems to be really reasonable. But there is no influence on either party. The seller is also not influencing you to buy it at a lower cost or a higher cost. And you are also knowing that 80 million is reasonable, you are going to willingly buy it. When that transaction happens, let's say at 80 million, which is called an arm's length transaction, then this 80 million becomes the fair value of the building. The fair value of the building. Now, this fair value concept can turn into another aspect also. Let's relate this cost and fair value now. Let's say you have constructed the building. So you have constructed a building which is after putting in all the material, raw material, labor, everything, you have constructed a building for, let's say, 60 million. 60 million, that is the cost. Because of your bargaining power, you have got these materials at a lower cost, labor also at a lower cost. So you have somehow tried and put up the building for 60 million. But you know, a similar kind of a building in this area is about 80 million. So now comes the concept of fair value on top of the cost. You might have incurred a cost of 60 million to construct this asset. But when you look at the market value of this particular asset, it's about 80 million. So this is how the cost and the fair value works. Cost and the fair value are not the same in most of the cases. Cost is really the amount that you have spent to acquire or construct. But fair value is the amount which is generally acceptable to parties where they want to do an arm's length transaction. These definitions are very important because as we go on, we will be repeatedly talking about these cost, fair value, and so on. Useful life. So what is the useful life of an asset? So like human can live for, generally the accepted norm is about 70, 72 years. So even people can go on and live for more than that also. It's only an estimation. We think that people in general will live for about 70 years. But it is not a hard and fast rule where you say that, yes, after 70 years, everybody should die. No, it's not the case. Likewise, for assets also, that is for fixed assets also, we have to estimate a lifetime. We have to estimate a lifetime. And this is entity specific. That is, if you think that you can use the computer for 5 years, another person might come and say that, no, my computer can be used only for 4 years. So the 5 years that you decided becomes your useful life, whereas the 4 years decided by another person becomes their useful life. So what is useful life is the period over which an asset is expected to be used by the entity. I'm not going to look at the depreciable asset at this moment, the term. Let's park it for the time being. The period over which an asset is expected to be used by the entity. So if I'm saying that I'm going to use this computer for 5 years, that is what my useful life is. But that will be, or that could be different from another party. Another company might say, look, we are using computers only for 3 years. So in our case, our useful life for computers is only 3 years. Okay. Then adding on to that, it also go on to say the number of production or similar units expected to be obtained from the asset by the entity. Now, one kind of looking at the useful life is what I told you. in terms of number of years. Another kind of looking at the useful life is the number of production or similar units expected to be obtained from the asset. Now, this is very much relevant for manufacturing companies. When there are manufacturing companies, you know, they involve in large machineries, where they will have to spend millions and millions to buy those machines for their production. Now, how do they determine their useful life of these machines is not based on how long they can use it, because it cannot be estimated. You can't say. Sometimes a machine you use, within 6 months down the line, it can go wrong. Or sometimes a machine could go for even 3-4 years without any problem. So those type of situations have to be handled in a different manner. So how do we handle that? They look at the number of production or similar units. Now those machines will have a tagline to say that this machine can produce 500,000 units at up to a certain point without any problem. So you know this machine's manufacturing capacity is 500,000 units. So you will decide your useful life of the machine also to be 500,000 units. Until I produce 500,000 units, it could be over 1 year, or it could be over 2 years, or it could be over 10 years. We don't know. As long as you are going to produce 500,000 units, you consider that asset to be having a useful life of that amount. So useful life can be defined in two ways. One is the period over which an asset is expected to be used, or the number of production or similar units that are expected to be produced from the. Then we come to something called residual value. Residual value. This is again an important definition. Residual value is the net amount which the entity expects to obtain for an asset at the end of its useful life, after deducting the expected cost of disposal. This is again another concept. Now you are using an asset and you have estimated the useful life of that asset to be 5 years. So you are using it now. And you have come to the end of 5 years. You have come to the end of 5 years. So let's say this is a computer. But after 5 years also, this computer is working well without any problem. But you don't want to keep it. You want to have a change because there is new models which have come. So the working volume has increased. So you don't want to keep this machine forever. You want to get rid of it and you want to go for a new machine. So what is the option available? Either you discard this asset and buy a new machine, or you sell this asset for some amount and then you buy a new asset. Now getting rid of this asset by selling it out from the entity is called a disposal. Disposal means you are getting rid of the asset from the entity. This disposal could be for money or for free. It can happen in both ways. Say for example, after using a computer for 5 years, if you are managed to sell it to somebody else for an amount of 10,000, that is the value that you are expecting out of this asset after end of its useful life. So that is known as the residual value. That 10,000 rupees is considered to be the residual value. But this residual value has to be estimated on day one. That is, if you are purchasing the asset today, you have to estimate after this amount of years, I will sell this asset and get this amount. Now, this is something not practical because you don't know whether this asset can be used for this long. It is just an estimation. You think that it can be used, but there could be a situation where it cannot be used. Then, if it cannot be used, how can you sell it to somebody else after the number of years specified? So it is very unlikely that you think about a value after the useful life of the asset. However, if there is a value assigned to the asset after the useful life, that is called a residual value. That value is called a residual value. So in general, businesses don't consider a residual value for fixed asset. Say, normally put it as 0. Because I say I don't have a value, I will just discard it. But if you are getting something out of it by selling it after the useful life, that's a bonus for you. But what happens, some organizations, they do this type of charity work using these type of assets. That is, after using it for say 3 years or 4 years or 5 years, you can go and donate these items for people where they require those type of items. So it can go in the form of a donation to somebody else after the useful life, which is again a disposal. But this particular type of disposal is done at free. That is, you don't get a value. It's only the image that you create. You have done a CSR, social responsibility activity, by giving it to somebody who doesn't have those. So I have seen companies, many of the companies in today in Sri Lanka, what do? After using the fixed asset for so many years, they go out and donate it to various authorities like schools, these charity organizations, then there could be orphanages. So there are people who doesn't have access to these items, they will go and donate it to those people. Of course, we have to be mindful that it has to be in some sort of a usable condition. If that is something which is not usable, no point in going and giving it. But there are instances where you might not be able to use. Say, for example, computer items. After 3 or 4 years, if you are not in a position to use it, then you can't go and donate it also. But you have to get rid of the asset. You have to get rid of the asset. So what do? Now today, for electronic equipment, we say they do something called e-waste disposal. E-waste disposal. So here you give it to a company who will do the demolition part of the asset, and they will take the waste management part for you. Because you can't be keeping these computers which are already not in a usable condition in the business premise. So you want to get rid of it. So what you need to do is you need to get some of these e-waste companies where they will come and collect it from you. But the interesting part of it is here, to get it disposed, you need to pay. You need to pay a cost. So that is why here it says expects to obtain for an asset at the end of its useful life after deducting the expected cost. Now, for computer items, if you are doing an e-waste, then obviously you know that it is going to cost you. There is no benefit to you. It is an additional cost to you. So what is residual value? Residual value could be a value estimated by the management. I told you, today you have to decide, okay, I am going to use this asset, and after a period of 3 years, I will be able to sell this asset for 10,000 rupees. So which becomes very unrealistic because we don't know what is going to be the future. Okay. Right. So before moving on to the next one, I just want you all to make a small note. So let's try to make that note first. In businesses, the judgment of the judgment of the judgment of the useful life, the judgment of the useful life, the judgment of the useful life will be based on will be based on will be based on the experience based on the experience of the entity with regard to the use of the asset, with regard to the use of the asset. As a result, the useful life is an estimation by the company for the purpose of providing depreciation. For the purpose of providing depreciation. Next line. Since the useful life being an estimation, since the useful life being an estimation, it might be very difficult. For a company, to estimate the residual value. Therefore, most of the companies assume the residual value to be zero be 0 when they purchase the asset. When they purchase the asset. Okay, so that is what I wanted to highlight, because it will be very difficult for the companies to estimate the residual value, because when they are not sure with the useful life of the asset, it may not be correct for them to estimate a residual value also. So the next definition is the depreciable amount. As you told you earlier, there was a term called depreciable asset. So now we are talking about the depreciable amount. It is the cost of an asset or other amount substituted for cost less its residual value. Here comes now the combining the definitions one with the other. Now earlier we understood what is the cost of an asset, and now we understood what is the residual value of an asset. Now we talk about the depreciable amount of an asset. So what is the depreciable amount of an asset? Is the cost of the asset minus the residual value. Cost of the asset minus the residual value. So if you have gone with the the fair value of the asset, then it will be fair value minus residual value. Okay, so depending on which value you are having, based on that you will calculate the depreciable amount. The value which will be subject to wear and tear. So we talk about the wear and tear of usage of the asset. Yes. What do you mean by the wear and tear? The damage that is going to go through for the usage of the asset. Because as we go on and use a particular asset for so many years, you know that there is a deterioration of the value. So you have to account for that deterioration. That is what we call it as wear and tear. So now we know that we have the depreciable amount, which is costless residual value. And we earlier said under useful life, you see the period over which a depreciable asset. So if there is a depreciable asset only, you can estimate a useful life. Okay, right. So depreciable amount is costless residual. And now we understand what is depreciation is. Depreciation is the result of systematic allocation of the depreciable amount of an asset over its estimated useful life. Now comes the definition of the depreciation. So depreciation for the accounting period is charged to the net profit or loss for the period either directly or indirectly. Okay. So what we are going to do is, okay, there is one more definition, and we will finish that and then we'll go. I'll come to the depreciation part of it once we complete these two. Then we look at the carrying amount. As I told you earlier, we didn't look at carrying amount. I can go back and tell you where it was. Here you can say the main features of accounting. I told you determination of its carrying amount. So that is what we are trying to understand now. What is carrying amount? It is the amount at which an asset is recognized in the statement of financial position after deducting any accumulated depreciation, accumulated impairment loss. So now in your financial statement, that is statement of financial position is your balance sheet. In your balance sheet, when you are showing your fixed assets, it has to be the carrying amount at which you are showing. So what is the carrying amount? It is the amount at which an asset is recognized in the balance sheet after deducting any accumulated depreciation. So now carrying amount is basically your cost minus accumulated depreciation. Cost minus accumulated depreciation. Okay, so we will learn one by one what it is. Then entity specific value is something that where the entity thinks it is the most appropriate value that I should consider for an asset. Okay, so this is the theoretical definition. They say is the total of the estimated cash inflow from the usage of the asset within its useful time and the estimated residual value of the asset. So it's very rare that people use this entity specific value, but what it says is it is an estimation of the cash inflows. So now you have brought in a machine, and this machine might cost some value. Let's say it is about 5 million, but you don't want to say the cost of the asset to be 5 million. You want to look at this machine as a different value. So how you will look at a value is, now how much of a production can this machine do? Let's say 200,000 units, and each of these units can be sold at a price of, let's say, 100. Then what is the value of the machine is 20 million. 20 million. What they do is 200,000 units into the selling price. That will be the value that I'm going to consider as my fixed asset value. That is called the entity specific value. Entity specific value. Okay. So if you really look at it, the carrying amount and the depreciation is very important definitions. Okay, and now we look at what is the depreciation rate and the annual depreciation. So the depreciation rate is calculated 1 over useful life into 100%. This is one understanding that you need to have with regard to the fixed asset calculation. So I would like to show it in the board. Okay. So let's look at it on the board. So now we have been talking about various things. One is the cost. The cost. Sorry about it. Yes. So we were talking about cost. Cost is the amount paid. The amount. Then we also talked about useful life. What does that mean? How long used, or how long expected to be used. How long expected to be used. So generally we say this has to be more than 1 year. Okay, that is what we learned. Where how you will consider an asset to be fixed asset is where you consider that to be used for more than one financial year. That is your useful life. Then we also said residual value. So we had the cost, we had the useful life, now we are talking about the residual value. Residual value is what? I'm going to use this asset for so many years. After using it, if I can sell it for some value, okay, that value will be the residual value. So value after useful life. Value after useful. Now we say the depreciable amount. What is the depreciable amount? So I will put this as C, this as RV, residual value. So depreciable amount, I will say that as DA. So DA is equal to cost minus residual value. Cost minus residual value. Very important. Cost minus residual value. Okay. So we have the cost, we have the useful life. Now we have the depreciable amount, which is DA equals C minus RV, which is cost minus residual value. So I would like you all to take down this as a snapshot. It will be very useful for you to understand. Okay. Right. So now we are going to look at something called the depreciation rate. Okay, the depreciation rate. So I hope I can write here depreciation okay. So the depreciation rate is actually, which is the DR. How do we calculate it is, we say 1 upon I'll put this as useful life. So 1 upon UL okay, and this has to be number of years. So what are we trying to understand here? We say the depreciation rate for an asset, for a fixed asset, is determined as a percentage. And how do we calculate these percentages? I will go and divide 1 by the number of years I have estimated as my useful life. Now this is an estimation, you know that. This is an estimation. Now based on this estimation, I'm now going to say this is my depreciation rate. I'm going to depreciate an asset based on this amount of percentage, this amount of percentage. Okay, this amount of percentage. Is that clear? And finally, I would say, I'll write it on this side. I don't know whether it is visible. So let me write it at the bottom. Annual depreciation is equal to cost minus RV, cost minus residual value into depreciation rate. So this you can call it as AD. AD is equal to cost minus residual value into depreciation rate. Okay. So you have the whole thing in a snapshot like one sheet. Okay. So cost, the amount paid, useful life, your estimation with regard to how long this asset could be used. Then the residual value is value after the useful life. If you think that this can be sold for some amount, that is the amount. Depreciable amount is your cost minus residual value. And the depreciation rate means 1 divided by your useful life, which is in number of years, into 100%. And finally, annual depreciation is cost minus residual value into the depreciation. Okay. So I hope that is clear. If you have any questions, do you have any questions? Can I get a feedback? Do you have any questions? Okay. So let us do some questions. Right. Take down. Calculate. Calculate. Calculate the depreciation rate. The depreciation rate. Calculate the depreciation rate for the following. For the following useful lives. Following useful lives of assets. So I'll give you 2 minutes. If you can quickly calculate the depreciation rate for assets with the following useful lives. What are the useful lives? 10 years, 20 years, 6 years, 4 years, and 50 years. 50. The last one is 50. Can we have the answer for the first one? Yes, one person has answered it. In person. Right. So how do we calculate it? You know, depreciation rate is equal to 1 over useful life into 100%. So if you take the first one, 1 upon 10 into 100%. That is 10%. So very straightforward. So depreciation rate is 10% for 10 years. 10% for 10 years. Okay. Second one. When it is 20 years, what will happen? This becomes 5%. Becomes 5%. Okay. Next one. What is the answer? What is the answer for the third one? Very good. So when you put 6, and this becomes 16.67. Okay, so the percentage need not be always a round number, 5, 10, likewise. It need not be. It could be something in decimals also. So when you divide 100 by 6, you get 16.6666 something. So I have rounded it off for 2 decimals. So when you take it for 2 decimals, it will be 16.67. Yes, some of you have said 16.66. Yes, that is also correct. But when you round it off for 2 decimals, it will be 16.67. Okay. Then the next one, 4 years. 4 years. It will be, yes, 25%. 25%. And the last one, when you say 50 years, this becomes 2%. Okay. Is that clear? Right. Next question. Next question. Calculate the estimated useful life. Estimated useful life. Estimated useful life of the assets for the below mentioned depreciation rates. So I have given you 5 percentages for which I want you to calculate the useful life of those assets. Can you calculate quickly? So how do you calculate the useful life now? Now, the question here is, okay, so what you need to do is, the depreciation rate is given. So you are required to calculate a useful life. So what do we do here? We change this formula by taking the useful life here and bringing down the. So as a result, this becomes like this. Using the same formula, I have changed it. Useful life equals 100% divided by depreciation rate. So that is what we are going to use. So this is the formula. So when you look at the first one, 100% divided by 20%, you get 5 years. You get 5 years. Okay. Then it's a matter of replacing the numbers. To put 12.5, you will get 8 years. Okay. And when you put 2.5, 40 years. Then when you put 33.33, it's roughly approximation 3 years. And finally, when you put 25%, it's 4 years. So this is same as this. When it was 4 years, you got 25%. Now it is 25% means you will have 4 years. So I hope this is clear. Okay, calculation of the useful life and the depreciation rate when you are given the useful life. Okay. So what is actually happening? What is actually happening here? When the useful life is long, the depreciation rate becomes very small. You see? When you say 50 years, the answer you got was 2%. Okay? But the same when you say 4 years, you got 25%. Okay? So you have to remember, when the useful life is too long, the depreciation rate will be very small. Then when the useful life is very short, the depreciation rate will be 3 or higher. Okay, so this conceptually you need to remember this. Okay, so the companies have to be more knowledgeable about using these depreciation rates. So if one particular year you think that the computers can be depreciated for 4 years, and later on if you decide no, 4 years is too long, you have to bring it down. So what happens? When the useful life has to come down means the depreciation rate has to go up. Okay. So can we make a note there? The useful life of the useful life of assets and the useful life of the assets and the depreciation rate, the useful life of the asset and the depreciation rate has an inverse relationship. Inverse relationship. Inverse relationship. That is when the useful life is longer, when the useful life is longer, the depreciation rate becomes very small. The depreciation rate becomes very small. And vice versa. Vice versa. Okay. So we will do another question. Take down. A company decides to purchase a company decides to purchase a company decides to purchase. Can you all hear me now? A company decides to purchase a special kind of machine, a special kind of machine, a special kind of machine for rupees 275,000, for 275,000. According to the company, this machine could be used. This machine could be used for 5 years. For 5 years, effectively. They also expect that this machine will have a value of 25,000, a value of 25,000, a value of 25,000 after the expected useful life, after the expected useful life, after the expected useful life. Answer the following questions. Answer the following questions. Number 1, calculate the depreciable amount. Calculate the depreciable amount of the asset. Calculate the depreciable amount. Number 2, what is the residual value of the asset? What is the residual value of the asset? What is the residual value of the asset? Number 3, calculate the depreciation rate. Calculate the depreciation rate. Number 4, calculate the annual depreciation. Calculate the annual depreciation. Calculate the annual depreciation. And number 5, if the company sell this machine to another party in the sixth year, for rupees 40,000, for rupees 40,000. What is the impact to the company? What is the impact to the company? What is the impact to the company? Okay. So that is the question. So what is the question in summary? A company has purchased a special kind of a machine at a cost of 275,000, and they expect that this machine can be used for about 5 years without any problem. That is, effectively they can use it for 5 years, and they expect that they can get 25,000 if they dispose to somebody after the useful life. But what happens in the 6th year? They give it to somebody else, another company, for 40,000. So I have asked you 5 questions. One is depreciable amount. Number 2, the residual value. Number 3, the depreciation rate. Number 4, the annual depreciation. And number 5, what is the impact when they give it at 40,000? Okay. So please do those questions, and we'll continue when we meet next time. Okay. Have a pleasant weekend.